Why do prices creep up every year even when nothing about the product changes? Why does your bank suddenly change the interest rate on your loan? Why does one country seem to power ahead economically while its neighbor struggles for decades? All of these questions sit inside one single field: macroeconomics. At its core, macroeconomics is simply the study of an economy as a whole, rather than the choices of a single person or a single business. It steps back and looks at millions of people, thousands of companies, and entire nations moving together. The big forces it studies are things like inflation, growth, unemployment, interest rates, government budgets, and currencies, the forces that shape a country's direction over years, not days. This is different from microeconomics, which zooms in on individual decisions, why a shopper picks one brand over another, or how a single business decides what price to charge. Macroeconomics ignores those small details and instead asks bigger questions. Not why one product costs more, but why almost everything costs more. Not how one company is hiring, but what's happening across the entire job market in a country. It's less about specific transactions and more about the underlying pattern. And this matters to you personally, whether you follow financial news or not. Inflation determines how far your paycheck actually stretches. Interest rates determine what your mortgage, car loan, or savings account actually earns or costs you. Overall growth in the economy determines whether jobs are plentiful or scarce. You don't need an economics degree to understand these forces. You just need to understand a handful of core ideas. And once you do, the constant stream of economic headlines stops feeling like noise and starts making sense. Let's start with the most fundamental concept: the economy as a connected loop. Production, income, and spending aren't three separate things. They're really just different stages of the same continuous cycle. A business produces something and pays its workers to do it. Those wages become someone's income. That income gets spent on other goods and services. That spending becomes revenue for other businesses, which then produce more and hire more. Round and round it goes. Economists often call this the circular flow of the economy, and it's why a slowdown in one place can ripple everywhere else. If businesses produce less, workers get paid less. If workers get paid less, they spend less. If spending falls, other businesses see less demand and cut back too. This is exactly why confidence, or the lack of it, can cause an economy to slow down surprisingly fast. There are three main players driving this loop. Households supply labor, earn wages, and choose how much of that income to spend versus save, and their spending is one of the biggest engines of economic activity. Firms take that labor and turn it into goods and services, deciding how much to produce, how many people to hire, and how much to invest based on demand, costs, and their expectations about the future. And then there's the government, which collects taxes and spends that money on things like healthcare, defense, infrastructure, and public programs, directly injecting demand into the system. When all three groups, households, firms, and government, are active and confident, the economy expands. When any one of them pulls back sharply, the whole system feels it. Now, let's talk about the concept most people have heard of but few truly understand: inflation. Most people assume inflation simply means prices are high. That's not quite right. Inflation specifically means prices are rising over time, and as a result, your money buys a little less than it used to. If a coffee costs $3 today and $3.20 next year, that alone isn't inflation, it's a single price change. Inflation is what we call it when this kind of increase keeps happening year after year across a broad range of goods. It's also worth separating inflation from a temporary price shock. If gas prices spike for 2 months because of a supply disruption and then settle back down, that's a shock, not inflation. True inflation is when the general price level keeps climbing even after those temporary disruptions fade. This connects directly to purchasing power, which is simply how much your money can actually buy. When inflation is present, purchasing power quietly erodes. The number sitting in your bank account might stay exactly the same, but what that number can purchase shrinks over time. When inflation is low and steady, this erosion happens slowly and is barely noticeable. When inflation runs high, the value of cash can evaporate surprisingly fast, which is why simply hoarding cash during high inflation periods is often a losing strategy. So how do economists actually measure something as abstract as inflation? The most widely used tool is the Consumer Price Index, or CPI. Statisticians build a representative basket of everyday purchases, groceries, rent, transportation, energy, healthcare, and other common expenses, and then track how the total cost of that basket changes month after month. If the basket gets more expensive, inflation is rising. If the cost holds steady, inflation is cooling. It's important not to confuse inflation with the cost of living. Inflation measures the speed at which prices are changing. Cost of living measures how expensive everyday life actually is at a given moment. A place can have very low inflation, but still be extremely expensive to live in, because prices were already high to begin with. And a place can have relatively high inflation while still being cheap overall, because prices started from a low base. Low inflation doesn't automatically mean life is affordable. Here's another subtlety worth knowing. Official inflation numbers are an average across a typical household, but almost nobody spends money exactly like that theoretical average person. If a big chunk of your budget goes toward rent or groceries, categories that tend to rise faster, your personal experience of inflation can feel much worse than the official statistic. If you spend heavily on things that are getting cheaper, like certain electronics, your personal inflation might actually be lower than reported. So when people say inflation feels worse than what the news claims, they're often not wrong. They're just living a different basket of expenses. Where does inflation actually come from? There are really 4 underlying drivers. The first is demand-side pressure. When people collectively want to buy more than the economy can produce, businesses respond by raising prices. This typically shows up during booms, when jobs are abundant, credit flows easily, and confidence is high. The second driver is supply-side pressure, when it simply becomes more expensive or difficult to produce things, whether from rising energy costs, disrupted supply chains, labor shortages, or natural disasters. Companies pass those higher costs on to consumers, even if demand hasn't changed at all. The third driver is monetary, when the amount of money circulating in an economy grows faster than the actual output of goods and services. Each unit of that money becomes worth a little less. This is closely tied to central bank policy, and while expanding the money supply can support an economy in tough times, overdoing it for too long tends to fuel sustained inflation. The fourth driver is psychological, driven by expectations. If workers expect prices to rise, they push for higher wages. If businesses expect costs to climb, they raise prices ahead of time to protect their margins. If shoppers expect prices to go up tomorrow, they rush to buy today. These expectations can become self-fulfilling. Once enough people believe inflation is coming, their own behavior helps make it happen, which is exactly why managing public expectations is one of the trickiest parts of running monetary policy. Inflation also has real consequences for wages and debt. In theory, wages should rise in step with prices, but in practice, they usually lag behind, at least in the short run, meaning your real purchasing power can shrink even while your paycheck stays the same or grows slightly. This is sometimes described as a hidden tax on anyone holding cash or savings. Debt, interestingly, works differently. If you're repaying a fixed-rate loan, inflation can actually work in your favor over time because you're paying back that debt with money that's worth less than when you originally borrowed it. The catch is that inflation usually pushes interest rates higher too, which makes any new borrowing or any variable rate debt you already carry more expensive to manage. Now let's shift to the role governments play, mainly through spending and taxation. Governments spend on healthcare, education, infrastructure, defense, pensions, and social programs. And this spending directly shapes economic activity by injecting money into the system. On the other side, governments collect revenue through income taxes, corporate taxes, sales taxes, property taxes, and various fees and tariffs. The balance between spending and taxing is called fiscal policy. When a government spends more or cuts taxes, that's an expansionary fiscal policy, usually deployed to stimulate a slowing economy. When a government cuts spending or raises taxes, that's a restrictive fiscal policy, typically used to cool down inflation or rein in debt. This naturally leads to the topic of deficits and debt. A budget deficit happens when a government spends more than it collects. A budget surplus is the opposite. Deficits aren't inherently bad, in fact. During a recession, when private spending collapses as people lose jobs and businesses pull back, government spending can step in to fill that gap and prevent a much deeper downturn. The problem arises when deficits become chronic and large. Persistent borrowing builds up national debt, and higher debt means higher interest payments, which eat into money that could otherwise fund schools, hospitals, or infrastructure. If debt grows large enough, investors can start losing confidence in a country's ability to repay it, which pushes borrowing costs even higher, creating a dangerous spiral where a country has to borrow more, at worse rates, just to service debt it already has. Now let's talk about one of the most powerful institutions in any economy, the central bank. Think of the Federal Reserve in the United States, the European Central Bank, or the Bank of England. A central bank isn't like your everyday commercial bank where you deposit paychecks or take out a car loan. It's essentially the bank for the banking system itself. Its main job is maintaining price stability, meaning keeping inflation in check while also supporting financial stability and sustainable growth. It does this mainly through monetary policy, using tools like interest rates, reserve requirements, and buying or selling government securities. The most well-known tool is the policy interest rate. When a central bank raises this rate, borrowing across the entire economy becomes more expensive. Banks pass that cost onto consumers through pricier mortgages, loans, and credit cards, which slows spending and investment and helps bring inflation down. When the central bank lowers the rate, borrowing gets cheaper, encouraging people and businesses to take loans, spend, and invest, which can reignite growth. These interest rate moves also ripple into financial markets. When rates are low, investors often chase higher returns in stocks and real estate, pushing those prices up. When rates rise, bonds suddenly look more attractive because they offer better guaranteed yields, while stocks and property can lose some appeal since borrowing costs climb and future company profits get discounted more heavily. One more crucial idea here is central bank independence. The notion that a central bank should be able to make decisions free from political pressure. This matters because elected officials often prefer low rates and generous spending right before elections, even if it stores up inflation problems for later. Central banks that operate independently tend to be seen as more credible because markets trust they're focused on long-term stability rather than short-term political wins, even though in practice they still coordinate closely with government policy. Now let's zoom out to the global picture, starting with exchange rates. An exchange rate simply tells you how much one currency is worth relative to another. If your currency weakens against another, imported goods from that other country become more expensive for you, but at the same time, your own country's exports become cheaper and more attractive to foreign buyers. Exchange rates are ultimately driven by supply and demand for a currency. A fast-growing economy attracting lots of foreign investment sees strong demand for its currency, pushing its value up. A country plagued by high inflation or political instability tends to see investors flee, weakening its currency. Some currencies float freely, like the US dollar or the euro, with values shifting constantly based on market forces. Others are fixed or pegged, where a government or central bank actively manages the exchange rate to stay near a target level, often by tying it to the dollar or another major currency. This can bring stability, but it requires constant active management and reserves to defend. Which brings us to foreign reserves, assets a central bank holds, usually in foreign currencies, gold, or foreign government bonds, that can be used to defend the local currency or meet international obligations. If a currency starts falling too fast, a central bank can sell some of its reserves to buy up its own currency and support its value. It's also useful to distinguish gross reserves, the total assets held, from net reserves, which subtract any foreign liabilities that are due soon. A country might report a large headline reserve number, but once you subtract debts coming due, the actually usable cushion can be much smaller than it first appears. This naturally leads into international trade. Picture one country that's efficient at manufacturing cars and another that's better suited to growing coffee. Each sells what it's good at producing to the other, and both end up better off than if they'd tried to produce everything domestically. The key metric here is the trade balance, the difference between what a country exports and what it imports. Export more than you import, and you have a trade surplus. Import more than you export, and you have a trade deficit. Neither is automatically good or bad. A country can run a persistent deficit while still attracting enormous foreign investment, and a country can run a surplus while still struggling with weak domestic demand or high unemployment. What really matters is the underlying reason behind the number and how it's being financed. Money doesn't just move through trade, it also flows directly between countries as investment, which brings us to capital flows. Investors chase better returns, so if one country offers meaningfully higher interest rates or faster growth prospects than another, money tends to migrate there in search of yield. But returns aren't the only motivation. Safety matters too. When a country faces instability, high inflation, or a financial crisis, investors often retreat to perceived safe havens, stable currencies, gold, or bonds from more secure economies. In that sense, capital flows are a kind of real-time vote of confidence in a country's future. This brings us to public debt and country risk. It's worth separating domestic debt, money a government borrows from its own citizens and institutions, usually in the local currency, from foreign debt, money borrowed from abroad, often denominated in a foreign currency like dollars. Foreign debt carries extra risk, because if your local currency weakens while your debt is priced in dollars, suddenly those repayments become far more expensive in local terms. Debt itself isn't automatically dangerous, it's sustainable, as long as a country can keep servicing it without constantly needing to borrow just to cover previous borrowing, which usually requires solid growth and manageable interest costs. It becomes unsustainable when interest payments start growing faster than government revenue or economic output. Analysts track this danger through country risk indicators, like credit ratings and risk premiums, the extra interest investors demand to lend to a riskier country compared to a very safe one. A wider risk premium signals the market sees more danger, which in turn can weaken the currency and scare away future investment. Now for a metric you've almost certainly heard mentioned constantly in the news: GDP, or gross domestic product. GDP measures the total value of everything produced within a country's borders over a set period, usually a quarter or a year. Think of it as the economic scoreboard for an entire nation, telling you whether things are expanding or shrinking. Importantly, GDP counts everything produced inside the country's borders regardless of who owns the company doing the producing. A foreign automaker's factory built domestically still counts toward that country's GDP. It captures manufacturing, services, construction, and government activity, but it doesn't capture informal or illegal transactions, and it doesn't capture unpaid work like childcare or cleaning done at home. There's a crucial distinction between nominal GDP and real GDP. Nominal GDP is measured using current prices, so it can rise simply because prices went up, even if actual output stayed flat. Real GDP strips out the effect of inflation by using constant prices from a fixed base year, giving you a much clearer picture of genuine growth. If a country's nominal GDP grows by 10% in a year, but inflation was running at 8%, the real growth was closer to 2%. A very different story. Finally, there's GDP per capita, simply total GDP divided by population, which gives a rough sense of average output and living standards per person. It's not a perfect measure, since it says nothing about inequality or quality of life, but it remains a useful way to compare economic scale across countries of very different sizes. Now let's talk about the natural rhythm every economy goes through, the business cycle. Economies move through 4 repeating phases: expansion, slowdown, recession, and recovery. During expansion, spending rises, businesses hire, and production climbs. During a slowdown, that momentum starts fading, businesses grow cautious, and consumers pull back. A recession is officially when an economy contracts for at least 2 consecutive quarters, a period marked by rising unemployment, falling confidence, and shrinking spending, the part of the cycle everyone actually feels in their daily life. Recessions can be triggered by many things. Sometimes businesses simply expect weaker future profits and cut back investment. Sometimes a sudden shock hits the system entirely, like the 2008 financial crisis, which began when housing prices collapsed and banks absorbed massive losses, freezing up lending across the entire economy. Or consider the pandemic-driven recession, triggered almost overnight by lockdowns halting business activity and consumer spending. Eventually, recovery kicks in, spending picks back up, hiring resumes, and production climbs again, often helped along by governments increasing spending and central banks cutting interest rates to encourage borrowing, exactly what happened globally during the pandemic response. And then the cycle simply continues, expansion feeding into slowdown, slowdown into recession, recession into recovery, shaped constantly by shifting technology, policy decisions, consumer psychology, and global events. So how does all of this actually connect to your own financial decisions? One practical tool worth knowing is the economic calendar, a running schedule of upcoming data releases like inflation reports, GDP figures, and central bank rate decisions. These releases move markets because they shift expectations about future growth and interest rates. If inflation comes in hotter than expected, markets often start pricing in higher future interest rates, which can ripple through stock and bond prices almost immediately. The real value of understanding macroeconomics isn't being able to perfectly predict what happens next. Nobody can do that reliably. It's understanding the environment you're operating in well enough to make smarter, more informed decisions with your time, your career, and your money.